When one currency quietly shifts direction, it can completely change how traders see the entire market. And that's exactly what's happening with the Japanese yen right now. The Japanese yen is pulling back after recently hitting a one-week high against a generally weaker US dollar during Wednesday's Asian trading, but the decline so far looks fairly contained rather than dramatic. Even though there has been growing talk that the Bank of Japan may be preparing markets for higher interest rates, expectations for another rate hike in December or January remain finely balanced, not a done deal. At the same time, worries about Japan's fragile public finances under Prime Minister Sanae Takaichi's pro-stimulus, spend-friendly agenda, combined with a global risk-on mood, are weighing on the yen's safe haven appeal. And this is where the story gets especially interesting. Japanese yen under pressure despite BOJ talk. On the one hand, markets are hearing more from the Bank of Japan about the inflation risks created by a persistently weak yen, which many see as a hint that a rate hike as early as December is still firmly on the table. Reports suggest this shift in tone followed a key meeting between Prime Minister Sanae Takaichi and BOJ Governor Kazuo Ueda, which appears to have eased immediate political resistance to tighter policy from the new government. Yet the yen is not soaring, because investors are also focused on Japan's heavy debt load and the administration's willingness to support growth with generous fiscal measures, a combination that keeps some traders cautious about the currency's long-term strength. Fresh economic data from Japan shows why the BOJ feels more confident that inflation might finally become sustainable rather than just a temporary spike. The Services Producer Price Index, an indicator of the prices that companies charge each other for services, rose 2.7% year-on-year in October, a slowdown from the revised 3.1% in the prior month, but still close enough to suggest Japan could be on the cusp of consistently meeting the BOJ's 2% inflation goal. That supports the case for further gradual tightening and gives the yen some underlying support during Asian hours, even if the broader narrative is far from straightforward. US dollar weakens as Fed rate cut bets grow. In contrast, the US dollar has slipped to a one-week low after a batch of US economic figures released on Tuesday failed to impress, reinforcing the market view that the US Federal Reserve is likely to cut interest rates again in December. Adding fuel to that expectation, Fed Governor Stephen Miron publicly backed a more dovish stance, noting in a television interview that a softening labor market and a cooling economy argue in favor of sizable rate reductions to bring policy closer to a neutral setting. When traders think US rates are heading lower, the dollar often loses some of its shine, which can help limit how far the US dollar to Japanese yen pair can climb. But here's where it gets controversial. Some investors think the Fed might be easing too soon, risking a later inflation rebound. Lower US yields and fading fears about a deep global downturn are encouraging investors to seek out riskier assets instead of hiding in classic safe havens. Hopes for progress toward a peace framework between Russia and Ukraine, after President Volodymyr Zelensky signaled readiness to advance a US-backed proposal, are also adding to this appetite for risk. In such an environment, currencies like the yen that typically benefit when fear is high can struggle to attract demand, as traders instead watch delayed US releases such as durable goods orders and weekly initial jobless claims for fresh short-term trading cues on US dollar to Japanese yen. US dollar to Japanese yen technical picture, key levels to watch. From a technical analysis standpoint, the US dollar to Japanese yen pair has recently settled below its 100-hour simple moving average, and the 38.2% Fibonacci retracement of the latest upswing from the monthly low, signaling that sellers still have some control in the near term. Short-term oscillators on the hourly chart are pointing lower, which reinforces the idea that the pair could see additional downside in the intraday window. However, daily chart indicators remain in positive territory, suggesting that any deeper pullback may encounter solid buying interest around the 155.30 region, near the 50% retracement, followed by a psychologically important floor at 155.00. If that 155.00 area were to give way decisively, it could act as a fresh trigger for bearish traders, potentially opening the door to more pronounced losses as stop orders get hit and sentiment turns more negative. On the upside, attempts to rebound above the 156.00 handle now face an immediate test around the Asian session high near 156.35, a zone that intraday traders are watching closely. A sustained break above that resistance could spark a short covering rally, allowing US dollar to Japanese yen to retake the 157.00 round figure and possibly extend toward 157.45 to 157.50, before targeting the 158.00 neighborhood, which marks the highest level seen since mid-January. Risk sentiment explained in simple terms. In market jargon, risk-on and risk-off are shorthand ways of describing how much risk investors are willing to take at a given moment. In a risk-on environment, investors generally feel more optimistic about the future, so they are more comfortable buying assets that can offer higher returns, but also carry higher risk, such as stocks, high-yield bonds, or emerging market assets. In a risk-off phase, by contrast, fear or uncertainty dominates, and investors tend to shift towards safer instruments that may offer lower returns, but are perceived as more reliable, for example, government bonds or safe haven currencies. Typically, during risk-on periods, equity markets tend to rise, many commodities appreciate in value, and even newer asset classes, such as major cryptocurrencies, can see broad gains as investors chase growth. One interesting nuance is that gold does not always move in lockstep with other commodities. It often behaves more like a defensive asset than a pure growth play. Currencies of commodity exporting countries usually strengthen in these phases, because stronger global growth expectations imply higher demand for their raw materials. Yet this is exactly where opinions can diverge, as not everyone agrees that cryptocurrencies, for instance, truly qualify as a risk-on asset in the traditional sense. In risk-off markets, the pattern often flips. Major government bond prices generally rise as investors look for safety. Gold tends to shine as a store of value, and safe haven currencies draw more interest. The Japanese yen, the Swiss franc, and the US dollar commonly benefit in these conditions, each for slightly different reasons. The US dollar often gains, because it is the world's primary reserve currency, and because US government debt is widely viewed as extremely secure, given the size and depth of the US economy. Why some currencies love risk-on and others love risk-off. Certain currencies, such as the Australian dollar, the Canadian dollar, the New Zealand dollar, and smaller commodity currencies like the Russian ruble and South African rand, tend to perform better when markets are in a risk-on mood. This is largely because their economies depend heavily on exporting commodities like metals, energy, and agricultural products, which usually see stronger demand and higher prices when investors expect faster global growth. For example, if traders anticipate a boom in construction and manufacturing, they may expect higher demand for iron or oil, or other raw materials, which can support the currencies of countries that export these products. On the other hand, in times of stress or crisis, different majors usually take the spotlight. The US dollar tends to rise, because of its reserve status and the perception that the United States is unlikely to default on its obligations, so US Treasuries are treated as a safe haven. The Japanese yen often strengthens as well, partly because a large share of Japanese government bonds is held domestically, reducing the risk of a sudden foreign investor exodus even in turbulent times. The Swiss franc benefits from Switzerland's reputation for financial stability and robust banking regulations, which many investors see as offering extra protection for their capital. Now for the big question, with Japan juggling potential rate hikes, a heavy fiscal burden, and a shifting global risk mood, is the yen still a reliable safe haven? Or is that reputation slowly fading? Do you agree that the current risk-on environment and Japan's fiscal worries justify the yen's latest pullback? Or do you think markets are underestimating the BOJ's willingness to tighten further? Share whether